All right, let's talk about those huge make or break decisions that every leader eventually faces. We're diving into capital investment. And look, this isn't just about spending a bunch of money. It's about making a calculated bet on the future of your entire company. It's about turning those big, ambitious plans into real, profitable results. So put yourself in the hot seat for a second. Your company has $1 million ready to go. On one hand, you could build a brand new factory to ramp up production. On the other, you could pour it into a massive digital overhaul to make everything more efficient. Both sound good, right? But you can only choose one. How in the world do you make that call? And trust me, this is not just some textbook exercise. Every single leader at some point is going to face a decision just like this. And these choices, they have a massive long-term ripple effect on your profitability, your efficiency, and ultimately where you stand against the competition. Getting them right is absolutely fundamental. So how do we get past just a gut feeling or picking what sounds best? Well, that is exactly where investment appraisal comes in. You should think of it like a specialized toolkit. It gives you a scientific, data-driven way to look at a project, weigh its upfront cost against all the money it's supposed to make you down the line, and gives you a clear, objective answer. Okay, so before we can even open up that toolkit, we have to get our heads around what is, and I'm not exaggerating, probably the single most important concept in all of finance. It's a fundamental principle that completely changes how you have to look at every single dollar a project might earn in the future. And here it is, the time value of money, or TVM. The big idea is actually pretty simple. A dollar in your hand right now is worth more than the promise of a dollar a year from now. But why? Well, it's all about potential. You could invest that dollar today and start earning interest on it immediately. Not to mention, things like inflation and just plain uncertainty mean that a future dollar probably won't buy you as much anyway. This hourglass visualizes it perfectly. Think of the money at the top. That's the cash you have today. It's full of potential, ready to be put to work. But as time passes, as that sand trickles down, its relative value changes. The money you get later on, at the bottom, is just, well, it's worth less than the money you have in your hand right now. And what's really cool about this little table is how it shows that potential earning capacity in action. Let's say you invest £10 with a 10% interest rate. Easy enough. After year 1, you've got £11. But here's the magic. In year 2, you earn 10% on the entire £11, not just your original 10. That little extra is compounding, and it's the engine that gives today's money so much more power. So, now that we've established that the timing of your money is critical, we can finally open that toolkit and look at the techniques that are actually built on this very idea. This is how we start turning those raw financial forecasts into a solid, defensible decision. Okay, so all these investment appraisal tools really fall into two main categories. You can see them here. On one side, you have what we call discounted cash flow methods, things like net present value and IRR. These are the modern gold standard because they totally respect the time value of money we just talked about. On the other side, you've got simpler, non-discounted methods like the payback period. They're kind of a quick and dirty measurement. The huge dividing line between them is whether or not they acknowledge that a dollar today is worth more than a dollar tomorrow. Let's break that down just a bit more. Over on the left, the discounted cash flow methods are the sophisticated players. Their whole focus is on genuine, long-term value creation, which at the end of the day is the number one goal for any company. Now on the right, the non-discounted methods are much simpler. They're really just answering one question: how fast do I get my initial investment back? And while that can be useful for a quick risk assessment, it's a dangerous way to make a final decision because it ignores both the time value of money and a project's total profitability. So for the rest of our time here, we're going to zero in on the absolute gold standard of these sophisticated methods. This is the one that's most widely used and respected in modern finance for making these huge capital decisions. We're talking about net present value, or NPV. So what exactly is it? Well, NPV basically does three things. First, it looks at all the cash you predict your project will bring in over its lifetime. Second, it uses a special interest rate called a discount rate to pull all that future money back and figure out what it's worth in today's money. We call that its present value. And finally, it subtracts your initial upfront investment cost from that total. Now, I know formulas can look a little intimidating, but don't worry about it. All this is really doing is telling the story we just described. This chunk right here, that's the engine that discounts all your future cash flows back to today's value. And this part is just your initial investment. The final answer is the net value the project will add to your company, measured in today's dollars. And this is the best part. You do all that work and you're left with this beautifully simple decision rule. If the net present value is positive, if it's greater than 0, the project is set to create more value than it costs. You accept it. If the NPV is negative, it's a value destroyer. You reject it. It's that black and white. It gives you a really powerful, clear signal. Let's actually watch it work. So in year 0, right at the beginning, we have our big cash outlay, negative £750,000. Then in year 1, we expect to get £142,500 back. But remember the time value of money? That's really only worth about £129,000 in today's terms. And we just do that for every single year, discounting each future cash flow back to its present value. Then we add it all up, the negative cost plus all the positive present values. And the final result? A positive NPV of £81,875. According to our rule, this project gets the green light. Okay, so let's tie all of this together, because these are not just abstract exercises for a finance class. Understanding these tools is really about empowering you to make smarter, more confident strategic decisions that will literally shape the future of your organization. So here's your leadership toolkit, the key takeaways. Number 1, always, always respect the time value of money. Number 2, for any major capital decision, you have to use a formal appraisal technique, and NPV is the most robust. And 3, just remember that simple rule. A positive NPV creates value for your company, a negative one destroys it. This whole framework is designed to move you beyond guesswork and into making data-driven decisions that build a more profitable and secure future. You now have the exact framework that top executives use to evaluate million-dollar, even billion-dollar projects. So the only question left is, with these tools now in your back pocket, what's the next big value-creating decision you're going to make?